Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 20th, 2025. Good morning, everyone. I hope you're all ready to dig into a conversation that weaves market data, breaking news, and a few lighthearted moments into a coherent picture of where things stand in the global financial landscape.
Let's start with a quick market overview. On the major indexes today, we're seeing some modest gains. The S&P 500 is trading at roughly 5,699.33, up by about 0.9%. Meanwhile, the Dow Jones is at approximately 42,165, inching higher by around 0.88%. Over on the Nasdaq, the index has risen to close to 17,849, which translates to an increase of nearly 1.5%. To round out the equity market, the Russell 2000 is at about 2,084, posting a gain of roughly 0.8%.
Turning to the crypto space, Bitcoin is currently trading at around 86,166, though it's down by about negative 0.8%. Ethereum, on the other hand, is sitting near 2002, and it's experienced a more notable decline of almost negative 2.7%. In summary, while equities are quietly climbing, the crypto markets continue to show the kind of volatility that reminds us exactly why diversification is a watchword in today's investment strategy.
Now, shifting gears from our snapshot of the market at large, let's take a deeper dive into some major trends that are shaping the investment climate. One noticeable trend is the interplay between fiscal policy, global trade tensions, and monetary policy. For example, while traditional equity indices enjoy steady growth, bolstered by underlying investor sentiment and data, the disjointed performance of the technology-heavy Nasdaq relative to the broader S&P 500 suggests that investors are starting to clearly differentiate between sectors. It might be that the current economic recoveries are boosting industrial and consumer sectors, while tech faces headwinds in the form of regulatory concerns or perhaps investor fatigue after an extended rally.
In the crypto realm, the slight pullback in Bitcoin and Ethereum could signal a momentary rebalancing after a period of rapid gains and losses. Cryptocurrencies, by nature, tend to react strongly to shifting narratives around regulation and technology, and we continue to see this interplay affecting investor sentiment. In many ways, this evolving landscape serves as a reminder of the intrinsic volatility of emerging asset classes compared to the more stable, historically grounded equity indices.
Let's now get into a comprehensive coverage of the most important stories making headlines today. I've got a roundup of 10 stories that each provide unique insights into the market dynamics and the policy environment impacting our portfolios.
First up, we have news out of the United Kingdom. Recent reports indicate that the inflation expectations for February are raising eyebrows. The one-year inflation outlook has ticked up to 3.9% from a prior 3.5%. For the 5 to 10-year horizon, the rate has similarly edged up to 3.9% from 3.7%. This development poses a significant challenge for the Bank of England as it navigates its policies in a complex environment now further complicated by the ongoing tariff disputes. Notably, the current discussion around the United Kingdom charging a 20% VAT as if it were a tariff, a remark echoed by former President Trump, remains a sticking point in trade debates between the United Kingdom and the United States. If you've ever marveled at just how many ways inflation can creep into headlines, today is a perfect example.
Next, over the technology sector, there's pressing positive news from Nvidia. CEO Jensen Huang, in a recent interview with the Financial Times, didn't hold back his praise for the Trump administration's artificial intelligence policies. Huang went on to point out that his company sees enormous potential in investing hundreds of billions on electronics manufactured on U.S. soil. This endorsement from one of the industry's most prominent voices has contributed to a noticeable bounce in Nvidia's stock price. It's interesting to consider how government policy, consumer sentiment, and corporate strategy align in tech right now. You might even say that investors in the semiconductor industry are starting to feel a bit like they are riding a roller coaster fueled by both innovation and political dynamics.
Then there's the story from Tesla. According to Wedbush analyst Dan Ives, CEO Elon Musk now finds himself at a significant crossroads. Ives referred to it as a moment of truth, highlighting that Musk faces at least two major issues that need prompt resolution to avert a potential crisis at the electric vehicle giant. This isn't simply about production numbers or sales figures, it's a question of leadership and long-term vision, drawing sharp focus on the volatility that can come with persona-driven companies. It's almost as if every day there's a new chapter in the Tesla saga, reminiscent of a high-stakes thriller where the protagonist is constantly challenged by both internal and external forces.
In other news, the United States is reporting interesting dynamics in its labor market. Recent jobless claims data show that while the private sector continues to shed relatively few jobs, there is an emerging trend among ex-federal employees who were let go by the previous administration. They are now increasingly applying for unemployment benefits. This nuance in the labor statistics might point to a shift in how we interpret the health of our labor market. It's not just about headline figures anymore, but the underlying stories of who is impacted and how these shifts might signal broader changes in the workforce dynamics.
Also coming through the wire is a statement from President Donald Trump. He has been vocal in his latest calls for the Federal Reserve to step in and cut interest rates. According to Trump, a rate cut could serve as a critical support mechanism for his tariff strategies, essentially cushioning the economy during what he describes as a transitional phase. It's a bold appeal that underscores the continuing tension between political policy and central bank independence, a story that never seems to lose its dramatic flair in the world of market news.
Adding another layer, there's caution in the semiconductor space. One headline cautions investors, particularly those with significant exposure to Nvidia, to take note of potential vulnerabilities in the semiconductors and semiconductor equipment index. The rapid climb in this index might suggest that the sector is overextended. While many in the market look for momentum, there's also a cautionary note here. Rapid rises can sometimes be followed by swift corrections. It's a reminder that even in sectors that are rallying on innovation, the fundamentals need a careful check.
There's also a piece of upbeat news suggesting that the overall stock market might have finally bottomed out. A convergence of various factors, insider sentiment, consumer behavior, and economic data indicate that we might be on the cusp of a rebound. The idea here is one of cautious optimism. While the market isn't without its challenges, these indicators combined might present a well-timed opportunity for investors looking to catch the next upward wave. It's a sentiment that calls for a moment of reflection. Sometimes, amidst all the market noise, you just have to ask yourself, is it time to buy the dip?
As we switch gears to the energy sector, oil prices continue to present a mixed narrative. After finding some support on what appears to be a fall in fuel inventories, oil futures struggled to gain clear direction early today. This indecision in the energy markets is perhaps a metaphor for the global economic climate at large, where supply and demand factors are often at odds with geopolitical uncertainties. For those of you tracking commodities, it's a reminder that while oil has long been a barometer of economic health, it can just as easily become a wildfire of speculation and uncertainty.
Our next headline takes us into the realm of market commentary from a familiar face on television, Jim Cramer. His rundown of the top 10 things to watch in the stock market for today has been circulating on Wall Street. Although his commentary is often lively and sometimes brash, it offers plenty of food for thought. His list encapsulates a broad array of themes, from sector-specific concerns to macroeconomic trends, and invites investors to consider both the opportunities and the risks that today's market presents. Whether you agree with his take or not, it's always worthwhile to review multiple perspectives before making any decisions.
And to round out the news roundup, there's a retrospective look at the nickel market. The London Metal Exchange, or LME, was fined 3 years ago due to inadequate systems and controls, a development that many industry watchers believe is more than just historical footnote. The current discussion around nickel market volatility reminds us of past episodes when markets went haywire, and it offers an opportunity to assess how regulatory actions continue to shape market behavior. It's a fascinating arc of cause and effect that speaks to the broader themes of market stability and the role of institutions in safeguarding fair practices.
While these 10 stories span a wide range of sectors and topics, from inflation trends in the United Kingdom to the latest on Tesla's internal challenges, and even a look back at the tumultuous nickel market, they all share one thing in common. They each tell a part of the story that is our global market. Now let's transition to a detailed sector analysis, diving into areas like technology, energy, and finance, as these stories combine to create a broader narrative about where we might be headed next.
In the technology sector, the narrative is dominated by both promise and caution. On one hand, you have Nvidia's charge fueled by artificial intelligence policies and an aggressive expansion plan in the United States. This is emblematic of the broader technology industry, where companies are increasingly betting on domestic manufacturing and the rapid development of AI capabilities. Yet, as with any sector that's evolving at breakneck speed, there are underlying concerns. The semiconductor industry, as we mentioned earlier, is flagged by some analysts for being perhaps stretched too thin. This juxtaposition of bullish corporate narratives with caution from market watchers provides us with a scenario where robust growth is tempered by pragmatic questions about valuation and sustainability.
There's a similar dual narrative in the energy sector. Oil, as we've noted, has enjoyed some price support due to falling fuel inventories, yet it remains directionless amid a larger backdrop of economic uncertainty. This uncertain environment is underscored by global geopolitical tensions and rapidly shifting supply dynamics. For instance, in many regions, energy policy is reflective of broader political strategies, where governments try to balance between tapping into fossil fuels and pushing for renewable alternatives. This strategic pivot is not only about environmental concerns, but about preserving economic stability in turbulent times. Investors should keep an eye on how traditional energy corporations and emerging renewable companies position themselves in the coming months. Today's energy landscape is very much a microcosm of the broader economic transformation underway.
Turning over to the finance sector, the interplay between fiscal policies, central bank actions, and political pronouncements continues to drive market sentiments. President Trump's recent calls for the Federal Reserve to cut interest rates serve as a stark example of the convergence between political agendas and monetary policy. Although such statements often generate headlines, they also prompt deeper questions about the central bank's independence and its long-term strategy in a politically charged environment. Adding to the complexity is the recent rise in inflation expectations in the United Kingdom, which, while not directly linked, contributes to a global narrative of policy uncertainty. For financial institutions, these questions go beyond political theater. They directly impact lending practices, investment strategies, and risk management.
Globally, that mosaic of trends has broad implications for international markets. While our U.S. indices are performing relatively well, we must remember that the economic story is unfolding on a global stage. Markets in Europe and Asia are similarly grappling with the aftershocks of policy changes, trade tensions, and the disruption brought about by rapid technological change. As investors evaluate their strategies, it's essential to consider how these local shocks may quickly become global trends. For example, the inflation data from the United Kingdom not only impacts local investors but also sends ripples through the global bond markets and currency valuations. Meanwhile, the semiconductor commentary resonates in markets like Taiwan, South Korea, and even Germany, where manufacturing and export models are deeply intertwined with technological advancements.
Stepping back a bit, what are the expert insights and predictions we can glean from all this? First and foremost, we are seeing a market that is both resilient and deeply complex. Trends from a traditional equities market suggest that investors retain a cautious optimism, tempered by recognition of underlying vulnerabilities, be it in the tech sector or in the broader economic undercurrents. The crypto scene, while still generating excitement and volatility, is a reminder that emerging asset classes remain a wild frontier. And then there are the geopolitical and policy nuances. While some of these might appear to be mere political posturing, they often herald more substantive shifts in economic policy and market regulation.
For instance, consider the policy push from President Trump regarding interest rate cuts. Such calls, though they might seem unconventional, hint at a broader strategy of using monetary policy as a buffer against potential trade shocks. This is particularly pertinent in a world where economic decisions are increasingly made in the context of global rivalry and domestic political pressures. How will central banks maintain their balance while navigating these turbulent waters? That is, if you ask me, one of the more thought-provoking questions of our time.
I'd be remiss if I didn't add a little lighthearted perspective here. Sometimes it feels like Wall Street could use a little hedge of humor to cut through the tension. Speaking of which, when I heard about the mixed messages in the news today, from inflation to semiconductor warnings, I couldn't help but think of my uncle, who always joked that the stock market is like a mood ring. It changes color depending on how it's feeling that day. And on days like today, it seems our market is sporting a vibrant spectrum of caution, optimism, and a dash of eccentricity. It's enough to make even the most seasoned investor crack a smile, even if just for a moment.
As we circle back to how all these threads tie together, it's important to note that while each sector and each headline offers its own narrative, the underlying theme remains one of interconnectivity. Whether you're watching the U.S. equity market or tracking global policy shifts, it's all part of a larger mosaic that defines today's economy. The market is like a living organism that reacts not only to data and news, but also to investor psychology, long-term trends, and shaping policies. This holistic view is something we at Pantheon AI try to capture every day, an approach that sees beyond the daily fluctuations and instead focuses on the bigger picture.
Before we wrap up, I want to offer a few expert insights worth pondering as you steer your portfolios. First, the upward momentum in major indexes like the S&P 500 and the Nasdaq indicates that investor confidence remains fairly strong, but it's matched by signs of caution. An emerging theme is that while these gains may suggest a robust recovery, underlying stresses, whether they're in tech valuations or broader fiscal uncertainties, should remind us that no market is immune to change. Secondly, keep a keen eye on sectors that are currently driving headlines. Technology, for instance, continues to surprise us with both its vigor and its vulnerability, and energy remains, as always, a barometer for global economic trends. Finally, always consider the broader ripple effects of policy changes.
When a headline emerges about interest rate cuts or inflation expectations, look beyond the immediate numbers and ask yourself how these shifts might ripple through global supply chains, consumer behavior, and even international trade.
As we bring today's discussion to a close, let's highlight some key takeaways. Markets are showing modest gains across the board, with traditional equity indexes performing well, even as the crypto sector sees some volatility. Major policy debates, like those in the United Kingdom concerning inflation and tariffs, are interwoven with corporate strategy insights from industry leaders such as Nvidia, and cautionary notes from sectors like semiconductors remind us to always stay vigilant. While technological innovation drives progress, the complexities of political and economic strategies, from Trump's calls for rate cuts to evolving consumer sentiment and jobless claims, continue to shape the investment narrative. And globally, the picture remains one of interdependent markets where every local movement has the potential to send ripples far and wide.
I invite you all to reflect on these insights and ask yourself a few important questions. How will you position your portfolios in a market that is simultaneously buoyant and brimming with caution? In this era of interconnectivity, are you considering global trends as much as local news? And finally, in a setting where policy narratives and investor sentiment are in constant dialogue, what role will emerging technologies play in shaping the investment strategies of tomorrow? These are questions that, while challenging, also offer tremendous opportunities for those prepared to look beyond the headlines.
As always, thank you for joining me on this morning's briefing. Your engagement and curiosity fuel these discussions, and I hope this episode has given you not only valuable insights, but also a few moments of levity in the midst of complex market analysis. Remember, Pantheon AI is here as your information co-pilot, guiding you through the ever-changing landscape of industry news, financial trends, and market surprises.
I encourage you to come back for our next episode tomorrow. There's always something new around the corner. And never hesitate to reach out with your questions to our AI co-pilot. After all, learning shouldn't feel like a full-time job.
Until next time, stay sharp, keep asking questions, and invest wisely. Have a wonderful day, everyone.